Every 4 years, Bitcoin has followed a predictable pattern: boom, bust, recovery, repeat. But in 2025, something feels different. Some analysts are claiming that the traditional market cycles no longer apply to crypto. Could they be right? Or is this just another costly misunderstanding of how the market actually works? Ignoring market cycles can be one of the biggest mistakes an investor makes. The truth is, these cycles still exist, but the key factors driving them have changed. While Bitcoin halvings once dominated price action, a much bigger force is now shaping the future of crypto. Welcome to the Chainpoint channel. In this video, we're diving deep into the forces that truly dictate Bitcoin's price, from its growing correlation with traditional markets to the role of the US dollar and central bank policies. Let's get into it. But before we continue our talk, don't forget to hit the subscribe button to stay tuned to what is happening in the crypto world. And remember, everything we say here is not investment advice. Always invest wisely. Let's get started. For years, crypto investors have followed a familiar pattern: a massive surge in prices, followed by a crash, consolidation, and eventually another bull run. But in 2025, many voices are claiming that these cycles no longer exist. The reality, however, is quite different. Believing that market cycles have disappeared can be a costly mistake, as failing to recognize these patterns often leads to poor investment decisions. The fundamental reason why market cycles persist is human psychology. Investors go from extreme euphoria to complete despair, creating waves of buying and selling that fuel these repetitive trends. These emotional swings aren't unique to crypto. They've been observed in traditional markets like the S&P 500 for over a century. Bitcoin itself has experienced 4 major cycles throughout its history, each lasting approximately 4 to 5 years. These cycles are not random. They align with key macroeconomic events, liquidity changes, and investor sentiment. Dismissing them outright ignores the underlying mechanics of how money flows into and out of the crypto space. Without this perspective, traders may find themselves caught on the wrong side of the market at the worst possible time. The key takeaway: understanding market cycles isn't just useful, it's essential for long-term success. While specific details may evolve, the fundamental rhythm of boom and bust remains. Those who adapt to these repeating patterns position themselves ahead of the crowd, while those who ignore them risk losing out on the biggest opportunities the market has to offer. And if cycles are still in play, what's actually driving them now? Let's break it down. For a long time, Bitcoin halving was considered the primary driver of its price cycles. The logic was simple. With every halving, Bitcoin supply issuance was cut in half, leading to increased scarcity and a subsequent price surge. While this mechanism played a significant role in early bull markets, recent trends suggest a shifting dynamic. Since 2020, Bitcoin's price movements have become increasingly correlated with traditional financial markets, signaling a broader evolution in how crypto assets are valued. Institutional adoption has been a major factor in this transformation. As hedge funds, banks, and large investment firms have entered the space, Bitcoin is now seen as part of the broader financial ecosystem rather than an isolated asset. This has made it more susceptible to macroeconomic trends, particularly those affecting the stock market and global liquidity. When traditional markets experience high volatility, Bitcoin often follows suit, reinforcing this newfound correlation. One of the most compelling examples of this shift is Bitcoin's price behavior alongside major tech stocks like Amazon. Studies have shown that their price peaks often align, demonstrating a shared sensitivity to market-wide liquidity conditions. This means that traders who once relied solely on Bitcoin-specific events, such as halvings or regulatory developments, must now factor in broader economic trends to make informed decisions. The biggest takeaway: understanding Bitcoin's price action today requires looking beyond the crypto market itself. The days of Bitcoin moving in isolation are over. Instead, investors must pay attention to interest rates, stock market trends, and global liquidity conditions to predict where the market is headed next. Speaking of liquidity, let's dive into why it has become the most critical variable in today's crypto market. Global liquidity, often measured by M2 money supply, plays a crucial role in financial markets, including crypto. When central banks inject money into the economy, liquidity increases, fueling investment in risk assets like stocks, commodities, and cryptocurrency. Historically, Bitcoin has thrived during periods of monetary expansion, with past bull markets aligning closely with surges in global M2. This correlation is not a coincidence. When there is excess liquidity, investors seek higher returns, driving capital into speculative markets. In contrast, when central banks tighten monetary policy, liquidity dries up, leading to market downturns. Bitcoin's reliance on this liquidity cycle has become even more pronounced since 2020, as institutional adoption has linked it more closely to traditional markets. Studies show a strong correlation, above 80%, between M2 growth and Bitcoin's price appreciation. During liquidity booms, Bitcoin has surged by over 1,000%, mirroring trends seen in equities and commodities. This pattern reinforces the idea that understanding liquidity cycles is critical for anticipating market movements and positioning investments strategically. Looking ahead, the big question is whether we are entering a new expansion phase in global liquidity. Recent data suggests early signs of recovery, which could set the stage for another crypto bull run. But before jumping to conclusions, we need to examine another crucial factor: Bitcoin's increasing correlation with traditional financial assets. For years, Bitcoin was seen as an independent asset, unaffected by traditional markets. However, since 2020, studies have shown an increasing correlation between Bitcoin and major stock indices, particularly the Nasdaq. This shift is largely due to the growing presence of institutional investors who treat Bitcoin as part of a broader portfolio alongside tech stocks and other high-risk assets. When risk appetite is high, investors pour money into both tech stocks and Bitcoin. Conversely, when uncertainty rises, capital retreats from these speculative markets, leading to simultaneous downturns. This correlation is further reinforced by data showing that Bitcoin reacts to Federal Reserve policies just like traditional equities. Interest rate hikes, quantitative tightening, and macroeconomic uncertainty now have a direct impact on Bitcoin's price action. Understanding these connections is essential for traders as it allows them to anticipate market trends based on broader financial indicators. With Bitcoin now behaving more like a traditional asset, the next logical step is to analyze another key variable: the strength of the US dollar. Historically, Bitcoin's price has moved inversely to the dollar index, making it a critical factor to watch in determining the next market cycle. The US dollar index is very important in shaping global liquidity and, by extension, the crypto market. Historically, there has been an inverse correlation between Bitcoin's price and the strength of the dollar. When the dollar strengthens, global liquidity contracts, making risk assets like Bitcoin less attractive to investors. Conversely, when the dollar weakens, liquidity expands, fueling bullish trends in the crypto space. This relationship is driven by how global markets function. A stronger index signals capital flight to safe haven assets like US Treasuries, reducing available liquidity for speculative markets. On the other hand, a weaker dollar often coincides with increased liquidity as investors seek higher returns in riskier assets, including cryptocurrencies. This cycle has repeated multiple times, reinforcing its significance in Bitcoin's price trends. Recent market conditions highlight this dynamic. In late 2023 and early 2024, a surging US dollar index led to liquidity tightening, resulting in a slowdown in Bitcoin's upward momentum. However, with recent signs of dollar weakness and potential economic policy shifts, investors are closely watching for signals that could indicate a return to a more favorable liquidity environment for crypto. Understanding Bitcoin's relationship with the US dollar is essential for predicting market movements. But beyond just the strength of the dollar, another critical factor shaping the current cycle is the impact of global monetary policies, a topic that directly influences how liquidity flows in and out of financial markets. Monetary policy has become one of the most significant drivers of financial markets, including crypto. During the pandemic, central banks worldwide responded with unprecedented stimulus measures, injecting trillions of dollars into the economy. This flood of liquidity fueled risk asset rallies, including a historic Bitcoin bull run in 2020 and 2021. However, As inflation concerns grew, these same central banks were forced to tighten monetary conditions, triggering a prolonged correction in crypto and equities alike. The Federal Reserve, in particular, has played a crucial role in shaping Bitcoin's price action. Rate hikes, quantitative tightening, and shifting economic outlooks directly impact investor sentiment. When borrowing costs rise and liquidity shrinks, speculative assets suffer, as seen in the 2022 bear market. Conversely, expectations of rate cuts or stimulus programs can quickly reignite demand for Bitcoin and other cryptocurrency. Beyond the US, global monetary policy shifts also influence crypto cycles. The European Central Bank, Bank of Japan, and China's economic policies contribute to overall liquidity trends. Recently, emerging markets and Asian economies have begun exploring new stimulus measures, potentially setting the stage for increased liquidity in 2024 and beyond. This could create a more favorable environment for Bitcoin and the broader crypto market. As central banks attempt to navigate economic uncertainty, crypto investors must stay vigilant. The ability to anticipate shifts in monetary policy provides a strategic advantage, allowing traders to align their positions with the broader liquidity cycle. In the fast-moving world of crypto, risk and opportunity go hand in hand. One of the biggest mistakes investors make is ignoring global liquidity trends. Since liquidity drives market cycles, understanding when capital is flowing in or out can mean the difference between catching the next bull run or being trapped in a bear market. Staying ahead requires a strategic approach and constant monitoring of macroeconomic conditions. A major risk factor is central bank policy. If the Federal Reserve or other global institutions decide to tighten monetary conditions unexpectedly, liquidity could dry up, causing a sharp decline in crypto prices. Similarly, regulatory shifts or geopolitical instability can introduce sudden volatility, making it crucial for investors to stay informed and adaptable. On the flip side, opportunities arise when liquidity begins to expand. Historical data shows that Bitcoin and altcoins perform best when global M2 increases, institutional demand rises, and risk appetite strengthens. Identifying these moments early can lead to significant gains, especially for those who position themselves before the crowd. Ultimately, the key to long-term success in crypto is awareness. Investors who recognize liquidity trends and market cycles are better equipped to navigate uncertainty, minimize losses, and maximize gains. So, are crypto market cycles really broken? Not quite. The patterns still exist, but the forces driving them have evolved. Global liquidity, the strength of the dollar, and institutional adoption now play a bigger role than ever in shaping Bitcoin's future. If you're not paying attention to these factors, you're missing the bigger picture. Now, I want to hear from you. Do you think we're heading into a new bull market, or is more downside ahead? Drop a comment below with your thoughts. And if you found this video valuable, smash that like button and subscribe for more deep dive analysis on the crypto market. Make sure to turn on notifications so you never miss an update. The next few months could be game-changing and you'll want to stay ahead of the curve. Thanks for watching, and I'll see you in the next video.